She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.
I'm Debbie Marcoux, and I am the Mortgage Mom. I'm licensed by the Department of Financial Protection and Innovation under the California Business Consumer Services and Housing Agency, NMLS ID 237926. Also licensed in Arizona, 0941504. Florida, LO 76508. Georgia, 69178. Hawaii, 237926. Idaho, MLO 208-023-7926. Illinois, 031.005-8339. Nevada, 57237. North Carolina, I-210940. Oregon, Tennessee, 184373. Texas, Washington, MLO 237926. This is Debbie Marcoux, the Mortgage Mom. I just wanted to remind you that when you think of something that you need in real estate or mortgage, to think about Mortgage Mom Radio. We can help you with your purchase, your sale, your refinance, your home equity line of credit, reverse mortgage, hard money, construction, you name it, we're here to help. So give us a call. It's 844-935-3634. That's 844-WE-LEND-FOR-YOU. WELEND and the number 4. Or head on over to my website at mortgagemomradio.com. All right, so welcome to Mortgage Mom Radio. I'm Debbie Marcoux. I am a mortgage mom, and I have not been on in a couple of months. So I do apologize, but welcome back. I'm so excited to be here, and I'm so excited to bring you guys a new show this week. I have had, I think I've mentioned this in the previous shows, but I've been dealing with some skin cancer, and I had bandages all over my face. I've been cut on my cheek. I've had 2 cuts on my forehead. I've had a cut on my back. So I think that I'm just about out of the woods, thank goodness. And it was the holidays. So I figured what better time to just turn the show off, recoup, relax, enjoy the season, and then get back at it. So here we are. It is February the 4th. And as I am sure you guys have all heard, that interest rates have come down. Now, there's been a lot of news outlets, saying lowest rates in 3 years. Interest rates are very, very good right now. They are a little tiny bit higher than where we hit our bottom, which I would say was about 2 weeks ago. So they did pop up just a little bit, but we are better than where we were about 7-8 months ago when we had our last drop. So we're going to talk a little bit about what has been happening with the market. How long did it take from one drop to the next drop for us to see, that next tier down in those interest rates? And then we're going to run some scenarios live. So I want you guys to see how we get to interest rates. I've said it many times before on many different shows, but every single person gets a different interest rate based on their personal scenario. So I kind of want to walk you guys through that and see how your interest rate, you are brave enough. I want you to put your scenario in the chat, or at least say, hi, I would love to do mine. And then I will ask you the questions that I need to ask you in order for everybody to see how we get to an interest rate and what those questions are. I think it will be very educational, and it might be kind of fun at the same time. Also remember that you guys are all just screen names, so nobody's going to know your personal information. You're not giving social security numbers. You're not giving addresses. You're not giving birth dates. You are just giving me some basic information that I'm going to ask. So nobody's going to know that it is you. And so please feel free to jump in if you'd like me to run your scenario, and you're actually getting a free rate quote without even having to call. So I can see Armando0385 jumps in, says, welcome back. I hope all is well. So thank you so much. It is good to be back. I'm happy to be here. I'm feeling so much better. It's nice to have the tape and the bandages off my face. Not that it really hurts all that bad, maybe a couple of days it's kind of sore, but it's more annoying than anything. And you can't put makeup on and it's hard to do your hair. So thank you so much. Everything is phenomenal and I hope all is well to you too. So let's talk a little bit about what happened previously. So it was about 9 months ago. And many of you, if you're my clients, if you're my past clients, you receive text messages from me. And I said, hey, interest rates have dropped, quite a bit from where your rate is today. Maybe we should take a look and see if it's something that would be worth doing. Maybe you want to refinance your current mortgage. And so we went through the scenarios, and that was about 9 months ago. So then it took about, a lot of the questions that the clients were asking was, should I do this now? Should I do this today? Should I wait? Do you think interest rates are going to get better? Do you think I'm, going to refinance too soon? And, the answer to that question was, the way that things look right now, it appears that we're now in the downtrending market. It looks as though interest rates are going to continue to fall. I don't think that it would hurt anything to sit and watch and wait just a little bit longer to see if we could possibly lock something in at a lower interest rate. And so we got those low interest rates and they stuck around for about 4 or 5 days. So let's call it a week because we've got 5 days in a working week. And then they went right back up again. And they actually shot up quite a bit that time. So we actually saw interest rates fall, lowest levels we had had in 2 years. And then all of a sudden they popped back up again. I'd say they went up about 0.375 to about 0.5%. So we got a nice drop and it only lasted for about 1 week, working week. So 4 or 5 business days. So I can say that Karen jumps in, says, great to have you back. Thank you for keeping us up to date with the newest interest rate discussion. So you're very welcome. And I love Karen. She is my mother-in-law. And then I've got Michelle EH7863 says, can't hear you. So if anybody else is having an issue hearing me, please let me know. Let me try to turn up the volume. But I think that Karen was able to hear me. So if you guys can hear me, say yes, you can hear me. And Michelle, I'm going to try to turn myself up. Don't know how much. You were back for a few words, but inaudible again. Very strange. Is anybody else having a problem hearing me with the same problem? Yes, you are coming in loud and clear. Okay, so Michelle, it might be Karen's hearing me just fine, but she's actually on Facebook. You're on YouTube. So if there is anybody else that is out there that is watching me on YouTube, can you let me know if I'm coming in and out for you on YouTube? Because it sounds like Facebook is loud and clear. So I don't know if it is Michelle's connection or if it is actually YouTube. So I don't know if Armando, if you're still on, or if anybody else is still on that could jump in. So Why Not says, welcome back. So thank you, Why Not? Why Not, since you're on YouTube with me, can you tell me if I'm loud and clear on YouTube or if I am breaking up on your end? Karen says, I had trouble on YouTube and jumped to Facebook. And then Nikki, Lake Havasu City. So she is my real estate agent. So if you guys need to buy something in Lake Havasu, Nikki's amazing. She says, I can hear you on YouTube. So I think, Michelle, it could be your connection. Maybe you could try to disconnect and come back in. Anybody else has any problems, please let me know. I do want to make sure you guys hear me, and I want to make sure it's not on my end that you guys are getting the sound issues. So let's keep going. So that time, about 9 months ago, we had like a week that interest rates stayed low. And we thought that they were going to continue dropping, and they just didn't. They spiked right back up again, and you guys had that window of time. Then everything kind of spiked back up, and it remained the same. I mean, we bounce every single day. That's what mortgage does. Just like the stock market, we bounce every single day, little bit up, little bit down, little bit up, little bit down, but nothing significant after that point. Our chart kind of went just straight across like this. All of the sudden, interest rates started to fall again, and we hit the bottom about 2 weeks ago. And then we did spike back up. And we did spike back up. If you talked to me 2 weeks ago, interest rates today are about 0.25% higher than they were 2 weeks ago. But now we're in the holding pattern again. So I'm hoping that this holding pattern is going to remain until we see our next possible big drop. Now, when is that next possible big drop going to happen? I have no idea, and nobody does. And anybody that is telling you that it's going to drop again quickly next week, in a month from now, and 2 months from now, there is absolutely no way to know. Nobody has a crystal ball. Nobody knows what's going on, outside. I mean, everything changes. So a lot of times with oil, we'll see mortgage is not tied at all. I want you guys to hear that. Mortgage is not tied to oil, but many times as oil is dropping per barrel, many times we also see mortgages will drop kind of at the same time. So you might see them kind of moving together, not that they're tied to each other in any way. So oil is kind of holding steady, mortgage kind of holding steady, and we don't know when the next big drop is going to be. Now, one of the big things that did happen is that, we do know that the federal chair, Jerome Powell, he is out come May. That is when his term is up, and Trump has already announced who he would be electing to come in as our next Fed chair. That gentleman, I am totally spacing on his name right now, and I am live, so I don't know it. I'm not going to give you guys a name right this second, but I did read up a lot on him, and he is very much an advocate of dropping interest rates. So why would he want to drop interest rate, and why does Trump want interest rates lower? So let's talk about that really quick, and then we are going to start jumping into scenarios, and I'd love you guys to jump in and say, hey, I'd like you to run a scenario, and then that way we can play your information up for everybody to see. So why would Trump, and why does the Fed chair-elect, why would they want interest rates to drop outside of just obviously the American people want interest rates lower to make things more affordable, right? There's a lot more to that. So basically, if you think about, and I'm going to give you a very, very easy to follow explanation. Obviously, you guys can jump into a rabbit hole and really start researching, but very, very just straightforward. How does it work? So all of the deficit on the books that we have, the government has, right? We all know we've got billions in deficit. That money is borrowed. The government has to pay interest on that money borrowed. So as interest rates are high, which Jerome Powell has kept interest rates high, it was, higher for longer was his, huge thing that he said over and over again. Higher for longer, higher for longer. The American people are resilient. They're still working. They're still paying their bills. Everybody's still got a job. Everybody's still spending. The American people can afford it. So let's keep it higher for longer. But the reason that Trump wants that interest rate to drop is because the government is paying interest on the deficit. And the interest that the government is paying is based on that Federal Reserve prime rate. So if the interest is dropped, then the government saves millions of dollars in interest that they have to pay, which then gets our deficit down easier and faster. They can pay that deficit down easier with interest rates being lower and less interest owed. So that would be the reason why Trump is pushing so hard for those interest rates to come down. That new chairman-elect that he said he wants to put in that space, he feels that that is also something that is very, very important, not only to the American people for being able to have things be more affordable, but also to help bring that deficit down. Now, there's a lot of people on each side of the spectrum that says if things get more affordable for the American people, it is human nature. They are going to go out and they are going to spend more, and it is going to drive our inflation up. The new chairman has said that he doesn't feel that that is going to drive the inflation up. So he's got a lot of reasons behind why he feels interest rates should have been dropped sooner. They shouldn't have been higher for longer. Trump has got his reasons why he wants them lower. And let's just say all of us as the American people, especially if you are in the real estate and mortgage industry, or if you are a homeowner and you have been paying an interest rate on your home of 7% plus or 6% plus. We are all hoping that when that new chairman comes in, which will be in May, that we are going to see these interest rates once again start to fall. Now, are we going to get a big drop in interest rates between now and May? There is absolutely no way to know. Are we going to get a drop in interest rates in May when he comes into office? There is absolutely no way to know. Would it make sense to believe that we will? Yes, that would be a good gamble, but will it happen? We just don't know. So if you have a mortgage that is in the 6s and the 7s and you want to try to refinance that loan and get into lower interest rates, it could be very quickly that rates drop again. It could be that it could be quite some time. It would be worth you giving us a call to find out where interest rates are today. How much would you be saving every month? And how long would it take for you to break even? So the cost to do the refinance versus the savings, and how long is your break even point? Because if it is not a very long break even, then you refi now, you save the money for now, interest rates fall even further, you refinance again, as long as you've hit your break even. So we'll talk about all of that obviously when we get on the phone together. But let's jump in and let's start doing some scenarios. I can see that Raul Cortez, E5N1I, I'm assuming Raul is your name. He says, very clear. Why not? Says, you're a bit low, but can hear you. Okay, so for the next show, I will work on getting the sound turned up just a little bit. And Rochelle Evans, 5669. So Rochelle, good to see you. She says, you are clear, but I did take you off my Bluetooth and put you on my speakerphone. So I might be a little bit low in the volume settings, so I will try to bring those up for next week's show. So let's jump into interest rates. And if there is anybody that is watching that would like to give me a scenario to know where an interest rate would be today, I would love for you to jump in the chat and say me, or hi. Please, let's do mine. If I don't hear from anybody, then I'm going to go ahead and just start doing a couple of scenarios for you guys. Now, we are going to do a little bit of experimentation here, because I would like you guys to be able to see my screen that I use when I run interest rates, but I don't know if it is going to turn my volume off as I am talking to you. So we're going to go ahead and we are going to change this here for a second. Let's go here. And let's go, nope. Okay, it doesn't look like it is going to maybe. Let's try this one. Nope. Okay, it's not going to let me do it while I'm live. I would have had to have switched it before I jumped into the show, or it's just me and I'm not very good at this. So I'm going to go ahead and I'm going to pull my screen over and I am going to run some scenarios for you guys. So I'm going to get logged into my pricing. Okay, so I think a really good way to compare, we're going to start off first until somebody jumps in that says they'd like me to do one. And we are going to start with what is the difference between a purchase and a refinance. So exact same loan amount, exact same value, but the difference between a purchase and a refinance. And remember that there are so many different types of loans that I'm going to give you guys a couple of different rates as well based on the scenario that I'm running. So we're going to start with somebody that has a 740 or better credit score. And we are going to assume a loan amount of $300,000, okay? Just to throw something out there, very basic. And then we are going to figure that the value of the property is $500,000. So whether you're purchasing it for $500,000 or you're doing a refinance and your property's value is $500,000. So we're going to start there. And the first scenario that I'm going to run is a purchase, again, 740 credit score. I am going to assume that the property taxes and the homeowner's insurance for the home are going to be bundled or impounded or escrowed. Those are all the same word and mean all the same thing, but in the monthly payment. If those are not included in the monthly payment, the interest rate changes. So again, these are all very important things to realize why everybody gets a little different interest rate. Now, I'm also going to assume that this is a single family home. If it was a condo or townhome, if it's a manufactured, if it is a 2 to 4 unit, so a duplex 3 unit or 4 unit, again, the interest rate would be different. So these are all important things to understand. Now I'm going to do just a standard Fannie Mae loan program, so conventional Fannie Mae loan program. And so this is my first one. This is going to be a purchase. So it's running the rate right now for that scenario. And that interest rate today, it's coming up. It's slower than me. Would be no points. So we can talk about points as well. If somebody wanted to buy their interest rate down, or if they were purchasing the home and wanted to ask the seller to help with some closing costs to cover points to buy that rate down lower, they could do that. But assuming that you don't want to pay any points, no extra fees up front to get the interest rate that you're going to get, we would be at an interest rate today of about 6%. So that is where a standard purchase, 30-year fixed, 740 credit score, no point, single family home, $300,000 loan amount, $500,000 in value would be. Now I'm going to change this and I'm going to revise my search and I'm going to call it a refinance. Now, this refinance is going to be different than a cash out refinance. So we are going to start first with a refinance with no cash out. All you're trying to do is lower your interest rate. Same exact scenario. So in this scenario for a refinance, no cash out at all, same exact setup. The interest rate on this one would be also 6%. So in this scenario, there is no difference between the purchase and the refinance. So now we're going to revise this search and we're going to pretend that the refinance is taking cash out. So now we're going to do a cash out refinance, same exact situation. So assuming that somebody owes, let's call it $250, and they want to pull out $50, and their new loan amount is going to be $300,000, okay? And this is going to change as what they owe to what the value of the property is moves up. So if they were taking a loan amount of $400 against $500, we'll run that scenario next. But let's stick with our $300 for now, cash out, and we're going to assume loan amount $300, okay? Coming. All right, same exact scenario, but this time cash out. Interest rate on this scenario would be 6.125. So instead of 6%, the interest rate would go up by 0.125 because you're taking the cash out, okay? But now let's pretend that you owe $300 today and that you want to take out $100, and we're going to do a cash out refinance for $400,000. Now, this would be the same if you had an equity line of credit. So many of my clients, while interest rates were in the 7%, 7.5%, and even, oh my gosh, in 2022 or 2023, I think we had gotten up to like 8.25 at one point. A lot of my clients decided to take home equity lines of credit instead of doing a cash out refinance because the interest rate on their mortgage was much lower that they had already secured than where interest rates were at that time. So they took a line of credit, $50,000, $100,000. And so let's talk about, we want to consolidate. So if you're consolidating, you are considered a cash out refinance. Or if you just wanted to pull out money and you wanted to do a cash out refinance. So now we're going to run a scenario assuming $400,000 loan amount with $500,000 value. So now you owe more against that property. Your loan to value percentage is higher than what it was for the 300,000. So we're going to keep this cash out and we're going to assume 400,000 cash out refinance. Again, nothing has changed. 740 credit score, impounding your taxes, single family home. So all of that, right? But now we're cashing out at an 80% loan to value, $400,000 loan amount. Now the interest rate, are you ready for this? It jumps all the way up to 7%. 7% because you went above 75% loan to value. So we have to talk about each individual scenario, each individual person. How much do you owe? What is your rate today? How much cash do you want? Okay, you don't want cash out. What is your credit score? Do you include your property taxes and your homeowner's insurance in your monthly payment? All of these things, what type of property do you have? So now let's take this 400,000 loan amount, but let's call this a purchase, not a cash out refinance. So now this is somebody that's doing 20% down payment on a purchase. And let's see how this changes. So 20% down, 740 credit score, 80% loan to value. And where are we at for your purchase? Oh, hey, look, we're not too bad. We're at 6.375 instead of 6%, which is where the 300,000 loan amount was now versus a 400,000 loan amount. So again, every single scenario is completely different. Is it your primary residence? Is it an investment property? Is it a second vacation home? What is the scenario? What is your credit score? Are you impounding? How much are you putting down? So now let's talk low down payments for my purchasers that are maybe going to do an FHA loan, okay? And we'll do some FHA refinances as well. So let's do a purchase. Let's keep the purchase price at $500,000. Let's assume that we're going to do a loan amount of $450,000. So you're putting $50,000 down. This loan to value is at 90%, okay? But we're going to run an FHA just to give you guys an idea of where would that FHA be. For a purchase, again, great credit score. For FHA, you always have to include taxes and insurance, so that would not be an option for you to remove those. So as of today, FHA loan, you guys are talking about an interest rate with only 10% down of 5.75%. So holy cow, an FHA has a lower interest rate with only 10% down than a conventional loan has with 20% down or more. So remember, the 300,000 purchase loan amount on the 500,000 sales price was actually an interest rate of 6%. So now let's do this FHA and let's make that loan amount even higher. So let's pretend that we're only doing 3.5% down payment. So when you have people that loan officers or real estate agents or somebody that tells you you should be doing an FHA loan, you've got a low down payment. This is why. So if you're putting 3.5% down and your loan amount is $475 and your value is, you're buying it for $500,000, so you're just putting that bare minimum down. Once again, interest rate today, 5.75. Still 5.75. So FHA is fabulous. Why would somebody select a conventional loan at 6% instead of an FHA loan, even if they had 20 or 30 or 40% down? Well, you would select the conventional loan because FHA loans have mortgage insurance. Conventional loans have mortgage insurance, but conventional loans do not have mortgage insurance if you have 20% equity. FHA loans have mortgage insurance regardless of how much money that you put down. So if you are going to put down less than 20%, many times FHA is going to be the direction that you want to go because you're going to have mortgage insurance whether you're conventional or whether you're FHA. But if you are putting down 20% or more, even though the interest rate is just slightly higher, your total overall monthly payment will be lower with conventional than what it would be with FHA, even though that interest rate is lower. So that is why somebody would select FHA or maybe conventional. So, nobody's really jumping in to say, hey, I'd like you to run my scenario. So I'll run a couple of more scenarios for you guys just so that you can kind of get an idea of what those interest rates would be today. Again, remember that this is informational only. I've got it in the actual body of the post of the show that we're doing. I can't guarantee an interest rate until it's locked in, and it is all subject to you guys being underwritten and approved. But this gives you some really good ideas of where things are at today. Now, I have a lot of purchases going right now that are below 6%. We're locking in at 5.75%. Why is that? Well, we are getting into more of a buyer's market. We are getting a lot more buyers out there that are willing to buy, sellers that are negotiating a little bit more because they've been sitting on the market for a little bit longer. And so we are starting to see sellers helping out with some closing costs, and they're able to buy those interest rates down. So we were getting a lot of these conventional purchases into interest rates in the in the high fives, which are great interest rates, to be honest with you. The average interest rate, if you go back 30 years, is actually a 7.5% interest rate. So we are getting down to those lower interest rates once again. Doing a lot of 2-1 buy down. So if we can get the interest rate to 6% today, and you can start your interest rate year one at 4 and then year 2 at 5. These interest rates and these monthly payments are starting to get a whole lot more affordable. And knowing that the goal is to get interest rates to come down further over the next year or two, a 2-1 buy down is a great option because it gives you a couple of years for interest rates to slowly make their way down as things change. Federal Reserve chairman change, and there's different decisions that are made that would bring these interest rates down lower and give you the opportunity to refinance the loan, into a lower interest rate that would remain the term of the financing. So again, things that we can discuss and we can talk about if you reach out to me and you give me a call. Now, again, this is an educational show, so I don't try to do too much plugging, but you guys do know how to get a hold of me. Go to my website, mortgagemomradio.com. Call my office, 844-935-3634. You want a scenario run that is personalized to you and you're feeling a little bit uneasy of putting your information into the chat, no big deal. Just send me an email, you guys. So it's Debbie, DEBBIE, at mortgagemomradio.com. So just send me an email and we'll chat back and forth through email, and I'll ask you all the important questions and I'll give you the information that you need. And you guys can always call me. So it's 844-935-3634. You can always call my office. You can go to the website. You can book a phone call. So if you guys want to jump on a call, you want to jump on a Zoom, you like to see somebody's face in person, happy to do that for you too. So Claudia jumps on and says, good to see you. I currently own a home and I am trying to get a loan to build an ADU. What are my options here and what interest rate am I looking at? Thank you. So Claudia, thank you so much for jumping in with that. That is a great question. And so we're going to use Claudia right now kind of as a way for you guys to see how a phone interview would go with me and a client. So if Claudia, get ready to type because I'm going to start asking you some questions, okay? So the first question is, what is your home worth today if you had to give me your very best guess? So I don't know if you've looked at Zillow in a while or Redfin in a while, or you just have an idea of what your home is worth. But if you had to guess, if I ordered an appraisal, where about do you think that value of your home would come in at? So that would be question number 1. Then question number 2 is, what do you owe on your home today? So whether you have just a first mortgage or you have a first mortgage and a home equity line of credit, both, what do you owe in total on all loans that are tied to your property today? So that would be question number 2. So what is your home worth? How much do you owe? Those are 2 questions for you to type into the chat. Question number 3, what do you think that your credit score is today? Best guess. So do you think you're a 700? Do you think you're a 720, a 740, a 680? That's very important for me to know as well. Where do you think that your credit score is today? Okay. Next question for you to type into the chat. Next answer is going to be Are you in a single family home? Are you in a condo townhome? I am assuming that you are in a single family because you are talking about building an ADU. Are you possibly a duplex or a triplex? So are you 2 to 4 units or are you 1 unit? So single family or are you units? So I need to know how many units that your property is today. Again, I'm going to assume that if you're talking ADU, we're not talking condos, townhomes. So these are important things for you to give me that information. I'm not seeing the information come in the chat, so it's hard for me to run the scenario for you until I see those answers pop up. Let me kind of refresh my chat and see if they're there. No, I'm not seeing those answers yet. So as soon as I see your answers come through, I'd be happy to run that scenario for you. And I'm going to have more questions for you as well once I get that information input. So Why Not says, what is an ADU? So that's a great question. Why not for somebody that doesn't know? An ADU is an accessory dwelling unit. So a lot of people that own single family homes or they own maybe a 2 to 4 unit property, but they've got space on their land, they can build an ADU. So think of it like a guest house or a vacation pool house, something that would be either attached or possibly detached, but on your same property. That is what an ADU would be. So something that people could stay with you at your home and they could utilize, or you could possibly even put tenants in and rent it out on a regular basis to create some extra cash flow. All right, so Claudia's answers are coming in. I love this. So she thinks her house is worth about $900,000. She owes about $500,000. Single family home. So she says, I probably owe close to $500,000 on the 700s. Okay, that's probably her credit score in the 700s, single family home. So perfect. I love what you're giving me so far. And then Rochelle actually has questions about her. So we're going to talk about Rochelle's when we're done with Claudia's. So this is great. So Claudia, I'm going to say you said 700s on credit score. So I'm going to say let's go 720. If your credit score is below that, when I would run a credit report, I would give you examples of what you could possibly do to get the credit score improved before we would lock a rate. So remember, guys, I do a complete full consultation, but let's start with a 720. And she said that she owes about 500, but her property is worth 900,000. So the next question for you, Claudia, is how much money do you need to build that ADU? So I'm going to start with most people need that I've talked to that have called me where we've been in this scenario. Most people need about 200 to 250,000 to build the ADU. It depends on how big you're going. Are you doing 2 bedrooms, 1 bedroom? You just making it a studio, or you 1 bathroom? You doing a full kitchen? You just doing a little, sink and dishwasher and maybe a 2-burner stove. So it really depends on kind of on what your ideas are. So you could possibly do an ADU for as little as maybe 150,000. But let's say that we go 200. There she goes. Claudia says 300. So she needs about 300,000. So she owes 500 today-ish. She needs 300-ish. So that's going to put her about 800. But her home today is only worth 900. So we don't have the equity that we need to do just a straight up cash out refinance. So this is why I ask these questions. If you have the equity in your home to just be able to do a refinance prior to the build and get the cash in hand and then build the property on your own time, at your own speed, hiring whoever you want to hire to do the different parts of the job, we look at, can we do a cash out refinance in that scenario, get you the cash, give it to you, and let you do your thing. In this scenario, if Claudia needs 300,000 out and she's got a loan amount already of 500, her loan to value isn't high. It's not low enough. The loan to value isn't low enough to hand her all of that cash. So what could we do? Can we still get her the money? Absolutely. But how do we go about it? So number one, we would look at, can we do a line of credit for Claudia for the 300,000? because again, we want to get the cash in her hand. We want her to be the contractor in regards to selecting who's going to do the build and paying for things as she goes and just getting the project done. We don't want anybody over the top of her shoulder looking at everything that she's doing and, having to get projects signed off before we disperse more money. That's talking about a home improvement loan, right? So we're going to look at, could we do a line of credit for Claudia for the $300,000 instead of a cash out refinance? If we can do the line of credit for her, she does the build. Once the build is done, the property is complete. It's got its certificate of occupancy. It's been all signed off permits wise by the county. Then we look at doing a refinance, combining that first for 500, combining that line of credit for 300 into one new loan, because now an appraiser is going to go out and appraise the property based on the property having the ADU there. Where if I do get the cash out before she builds it, I'm doing the appraisal based on what that property's value is right there, the way it sits today. So in this situation, Claudia would be better getting the line of credit, getting the cash, building it, and then we do a refinance to consolidate the two. Now, if a line of credit, when we work on the line of credit together, if we can't get her the $300,000 out, we don't have enough equity, or we don't have enough of whatever reason to do it that way, then we could look at home improvement financing. So that is going to be something where we can get you based on the value of the property with the ADU complete. That is how the appraiser would do the loan, the actual appraisal. We would set up the loan. You would have to get me contractors' bids. We would have to get, everything approved. We've got to get all the bids approved. We've got to get your contractor approved. And we're going to help you throughout the whole process to get it built. And we're going to disperse money as the build goes, as things get finished and get signed off. And we're going to get somebody out there that's going to verify things are being completed as you go. So it is a little bit more expensive to do that type of financing, but it is totally doable. So we start with, could we get the line of credit, give you the cash, let you build it when you're done, do the refi. So I hope that helps, Claudia, and you can see how that very quickly shifted from, hey, I'm giving you a rate quote to do a cash out refi, to, hey, we've got to look at it a different way. So I would suggest, if that's what you're trying to do to get that $300,000, we need to get a little bit more detailed for you. We need to talk about lines of credit. We need to look to see how much cash could we get you out with the line of credit. If we can't go that direction, then we're going to look at doing it with a renovation loan. So I would say reach out to me by email, give me a call, and let's run some numbers going that direction first. And then if that doesn't work, if all else fails, we go into the renovation loan financing. So let's jump into Rochelle. Rochelle says, hi, we need to refi to consolidate home equity line that we built an ADU, which was $200,000 current loan. And current loan is $360,000. Credit score is 770, single family home. Can you tell me the monthly mortgage? So, Rochelle, I've got questions for you. So you gave me your 770 credit score. That's fabulous. I'm pretty sure that's what you meant. Credit scores are 770. And you said that your current loan's 360, and then you have 200,000 that you owe on your line of credit. So what do you think that your home is worth today? And I think, if I'm not mistaken, if this is the same Rochelle, we talked maybe 7 or 8 months ago, and I actually had an appraiser do some work for me and gave me a value, if you're the same Rochelle. So you should actually have an idea from what I had sent previously, if this is the same person. And Claudia says, so helpful. Thank you very much. So you're very welcome, Claudia. This is great. I love this, you guys. I love that you're giving me these scenarios, because I want people to kind of see how it would go if they reached out so that we could talk about things. But Rochelle, I do need to know what you think that the property is worth. So we do know that we need to get a new loan amount of about $560,000. And because, Rochelle, you did build the ADU with the home equity line, if you can provide to me all of the contractor's receipts and everything that you did in order to build that ADU, there is a very good chance that I could actually do this not as a cash out refinance. So somebody that took a $200,000 line of credit and paid off a bunch of debt, or went and bought a motorhome or bought a boat. If you actually took the money out and you did the improvements, sometimes we can actually get away with calling it a rate and term refinance. If I can show all of the contractor's information and bids and permits and everything, sometimes clients are like, that is so much extra work that I don't want to do. And so then we just call it a refinance. So Rochelle, you have to remind me. She says, yes. So it is the same person that I'm talking to that we talked to about 9 months ago or so. You have to remind me what my appraiser said that they thought your value of your house was. That way I can put that value in there. And then we are going to change this from a purchase to a refinance. I want to say, if I remember right, it was like $950 maybe, but I'm going to wait for her to confirm what I had told her. So 770 credit score, new loan amount 560. And let's go with 950 because I've got a pretty good memory, and I want to say it was somewhere around 950 that the appraiser had told me when we did some research. If that is wrong, Rochelle, I will wait for you, and then we can always update this when I run the number. So we're going to go conforming, conventional, so a Fannie Mae, not an FHA, because she's got more than enough equity to not have to pay mortgage insurance. So we would not want to do that. So in this scenario, she says, Ish, I don't remember. I'm pretty sure it was 950. So we're going to work with that. And then if you want to, you can get together with me, after the show in the next couple days, whenever, and I can always go back to our notes. I keep everything on my computer, so I've got our notes. But in this scenario, you would be looking, not paying any points at all. You'd be looking at an interest rate today of about 6% to 6.125. So you're going to be right in that middle mark. Again, no points at all. So in this scenario, the next thing that we do is, if I say, hey, interest rates are going to be 6.125, obviously got to get your application in before I can lock the rate. So we're going to be right in that area, no points, okay? So the next thing that we do is we jump to, does it make sense to consolidate? Because she has a mortgage right now that has an interest rate on it with a balance of $360,000. So, Rochelle, remind me what your current interest rate is on your mortgage of $360,000. So make sure that you type that into the chat. I am going to go to my blended rate calculator so that we can make sure that if we consolidate it all together at 6 to 6.125, that's going to be a better interest rate or give you savings over what you're paying right now with those loans separated. Because if I remember also correctly, she had something with the second, had a really low interest rate on it, and it was like for a short period of time, then eventually it was going to go up. But at the time that we talked, I think she was still in that beginning phase of that lower interest rate. So let's go to my blended rate calculator. Okay, current interest rate is 3.5%. And Rochelle, one more question. What was your interest rate when you first took that loan? I want to say it was maybe $400,000. I think you had gone down just a little bit because we want to run this accurately. Okay. And then we're going to do your $200,000 that you owe right now. What is the interest rate on that $200,000 that you owe? And I don't want today's rate if it is lower than where it is going to adjust to. I want you to tell me what is it going to adjust to, because that is going to be what we want to calculate it against. Obviously, if you still had 2 years to go or something on that initial upfront low rate, then we would talk about maybe it makes sense to still wait a little bit longer. But for purposes of the show, let's do it to where we are comparing where it will go to versus what would it be if you did it all together. So tell me what that interest rate is on that line of credit. Okay, so I'm just waiting for her current interest rate's 3.5, but I think that's on her mortgage. So what is the interest rate on your line of credit today? I'm just waiting for. Okay, so actually, while we're waiting for her, let's do some scenarios. So a lot of the lines of credit that home equity lines that people have taken, the interest rates are between 10% and as high as 13%. So that is kind of where the average home equity line of credit has been up until the Federal Reserve finally started cutting rates. Now we're starting to see 9.5, 8.5, 6.5. She said it's still low and hasn't adjusted yet. I don't remember the final amount. So I'm going to use a number. And again, Rochelle, you and I can talk after the show to determine if it would make sense to roll everything together for you, for your specific scenario with your introductory rate on the line that you have. But most of the clients that I have that have equity lines of credit right now, their equity line of credit is around 10, some as high as 13, 13 and a half, some maybe as low as 9. So I'm going to run this scenario with owing 300,000. I think you said 300,000. Was it 300? Let's go back. Or was it 360? 360. So let's make this 360 at 3.5%. And let's do 200,000 at 10%. So the blended interest rate that you are paying, if that is your scenario, is 5.82%. The interest rate today at 6%. So here is your question. This is where we would again go into numbers to determine what makes sense for you. So if that was the scenario, then do you want just a slightly higher interest rate, but to be able to consolidate it all together, have one mortgage payment per month, have it all principal and interest, meaning that most lines of credit are interest only. Most lines of credit are adjustable. They're going to move around. They're usually open and good for 10 years as far as the draw. Then they turn into a 20-year note that you've got to get it paid off in, and it turns to a principal and interest payment, typically at a higher interest rate. So does it make sense over 0.25% in cost? So you could keep what you have at 5.82. You can take a new one at 6. Does it make sense to get it all consolidated on the principal and interest? Every payment you make is paying your balance down. Do you want to wait a little bit longer? These are all things that we would discuss for somebody that was looking to possibly consolidate. In this scenario, it probably makes sense for this client to move forward, get it all wrapped up, know that the payment that they're making is paying their balance down. They're not on interest only. They're not making minimum payments to that second mortgage that is not paying that balance, and that balance is just sitting like a credit card and maintaining that same balance forever with every payment. But again, it depends on that person and have they been making extra payments to pay that balance down. So every person is a little bit different and have different reasons for why they'd want to consolidate. Michelle said, it's still low and hasn't adjusted yet. I don't remember final amount. Sorry. And then she said, can you tell me the monthly amount on a 650,000? So you're asking me what would the mortgage payment be for a $650,000 loan amount? I'm assuming, so that's what I'm going to run. And if I'm wrong, then you can answer in the chat. It seems like the chat comes in a little delayed. So let's revise that search and let's make that loan amount 650. And let's tell her now. I'm assuming she's going to be a cash out refinance because now we're going above what she owes on her first and second, which means she wants to consolidate and pull cash. So now we are 100% going to be a cash out refinance. So we are going to change that. Again, this is for Rochelle, 770 credit score, $950,000 value, 30-year fixed rate. So we're going to run this 650,000 loan amount. Now the interest rate, cash out refinance, would be at 6. 6.375% today. And the principal and interest on $650,000 would be $4,055 a month. That does not include your property taxes and your homeowner's insurance, but just to give you that info. Yes, so I'm pretty sure I answered what you were looking for, but if you want me to run another number, happy to do so. So as you guys can see, we have to kind of talk through the process and through the scenario together, because everybody's got just a little different situation of what they're trying to achieve. So maybe, she wants to pay off, the equity line of credit that she took. Maybe that build ended up costing her more than she anticipated. She ended up going to credit cards to finish the build, get it furnished, get a tenant in there. That happens. You have no idea how often that happens for clients. And so now what she really wants to do is to get it just all consolidated together and get it all put into one loan, so she just doesn't have to worry anymore. If I go back to that blended rate calculator, you can't look at that 5.82% that I gave you guys before, because it's different. So let's say that she had $100,000 in credit card debt, and we all know that credit card debt right now is super, super high. Interest rates are around, on average, a credit card is at 27%. So if that is the situation, she's actually paying, if she had $100,000 at a 27% credit card interest rate, $200,000 at 10% on the line of credit, and $360,000 at 3.5% on the mortgage, her blended rate is 9%. So it makes sense all day long, without a question of a doubt, to refinance, to consolidate everything into one new low interest rate at 6.375%. Again, that's with no buying down points, right? You can always pay to get a lower interest rate. I always recommend that we don't do that unless it is a purchase and the seller is paying to buy down the interest rate. But I don't recommend paying the points, because if interest rates do drop in the future, we would want to refinance again. And the last thing you want to do is pay for points for a lower rate that, number one, you won't get your money back. And then number two, you could have just been patient and in 6, 7, 8, 9, 12 months from now, refinanced again at that lower rate for free. So I don't recommend that. She said, thank you. So no impound. So I can't tell you what your mortgage payment would be with the impounds, because I don't know what they are here on the show live, in studio. You would have to actually tell me how much your annual property taxes are and how much your annual homeowner's insurance policy is. And then I'd be happy to run that total payment for you. But for me right here in studio, I don't know what those are. I don't know what those run you currently. So I can only give you a quick monthly payment at that interest rate. So $4,055 at 6.375 for a $650,000 loan amount. So if you want to throw that into the chat and tell me what your property taxes and insurance are, you can. Or you could grab your calculator and put, you've got $5,000 in property taxes, and you've got $2,000 a year in homeowners insurance. Put $7,000 in, divided by 12, and add that to $4,055, and that is your total monthly mortgage payment if you impound the property taxes and insurance. So you might be able to do that on your own, but I'm happy to do it for you. You just have to give me those details. So if anybody else has any other scenarios that they would like me to run, please feel free to put that into the chat. I am going to run a very, very quick commercial. So remember, you guys, this is my first show that I have done in about 2 months. So these commercials are commercials that I shot last year, probably in July or August of last year. So they might be a little bit outdated. They might be a little bit irrelevant. It's just going to give me 60 seconds to take a drink, let more people put things into the chat if they have questions or they'd like me to run a scenario. And then when I get back from that commercial, if nobody else has asked me another question or given me another scenario, then we'll wrap up the show. So stay tuned. We'll be right back. Hi, I'm Debbie Marcoux, the mortgage mom. Have you been waiting to get a debt consolidation done? You want to refinance, you want to pay off your debts, you want to do some home improvement. Maybe you've had your plans on hold forever. You want to sell, you want to move, you want to downsize, you need to upgrade, but you have been waiting for these interest rates to come down. Well, now is your chance. The Federal Reserve just cut interest rates by 0.25% today. They're talking about doing this again, possibly up to 3 times by the end of 2025. So this is your chance to give me a call, to reach out, to talk to me about your goals, and to get things started. How do you do that? Well, you call my office. It's 844-935-3634. That's 844 We Lend for You. WELEND and the number 4. You can also head on over to my website at mortgagemomradio.com. I do have a contact us button there, or send me an email to debbie@mortgagemomradio.com. Talk to y'all real soon. Bye-bye. Okay, so welcome back. Thank you so much, you guys. I just needed to get a drink of water. I've been talking for like an hour and I didn't stop. So Rochelle did jump in and she says, okay, we will check in May with you. So Rochelle, you are very welcome to check in with me anytime. Happy to go through numbers and then, wait till May. Guys, again, like I said, is the thought process and what would make a very reasonable, rash gamble to say that interest rates come May with a new Fed chair would possibly, should look better, should look lower. Yes, that would be a very rational gamble. However, nothing ever works that way. Ever. So there is a very good chance that even with a new chair coming in, that we don't see interest rates come down. Like I said, the last time that they started to come down was 9 months ago, and we really expected, even based on the person that was in power, everything that was happening, that rates were going to continue to come down further. And we got about 4 or 5 days with low rates, and then they popped right back up again. So there is no crystal ball. It is all a gamble. The question is are you somebody that sits at the roulette table and you always let it ride and you just keep going and you think that things will come down even further if you just wait longer? Absolutely, that could totally happen. Rochelle, if you've got $100,000 in credit card debt and you truly are paying a blended rate of 9%, I would not recommend waiting until May. However, if you don't have $100,000 in credit card debt and you're just looking to take $100,000 in cash out, maybe you want to do some home improvements to your main home after you get everything consolidated and you're in no rush for that money and you don't need it today, then maybe it makes sense to ride it out and see what might happen come May. So every single person is different, but I do want to make sure that you guys know there is no guarantee how long that it's going to take before we get our next dip. The last time took 9 months. So sometimes putting plans on hold for 9 months or paying credit cards at 27% in interest for the next 9 months while you're waiting and taking a gamble on the market for rates to come down further. Or sometimes it just doesn't make sense and it's better to get it done, get it all consolidated. And if interest rates come down further in the future, then we just do a rate and term refinance and we just, get you that lower interest rate at that time. So Michelle jumped on, said, should I pay more monthly to save on interest if mortgage rate is very low? Original loan was $590,500, July 1st of 21. Loan balance is $416. Congratulations, that's amazing. Monthly payment is $3,800 with no impound. Maturity date is August of 2036. 10.7 years left to maturity. Current home value is 1.3. Paid in 2025 was $87.47. So Michelle, should I pay more monthly to save on interest? I don't see why not. It depends on what else that you have going on in your life. I mean, do if you've got credit card balances that are at high interest rates, then obviously I would say before you take your money and pay it towards your mortgage that has a low interest rate because you took it out in 2021, I would pay off your highest credit balances first. So I would look at everything that you owe overall. And if you've got other loans, lines of credit, student loans, credit cards, anything that would have a higher interest rate, I would pay money towards that first And then I would put anything extra towards the mortgage once those are paid. If everything that you own is paid and you own nothing but your house and you want to get that paid off, some people prefer to have a mortgage. Their game plan, their financial goal is, I need a mortgage because I need the tax deduction and I don't want to pay more than what I need to. Those people take their extra money and they put it towards whatever investments that they feel are going to make them more money on the dollar than paying off something that's got a super low interest rate. Other people, their goal, their retirement plan, to them, the most important thing is to have their home paid off in full when they retire. They don't want a mortgage. They don't want a balance. They don't want their kids to inherit a property that has a loan on it. Every single person has a different financial goal, a different plan, and they have a different reason for why they do what they do. So obviously, if you can pay things down, always great. Pay it down, faster the better. Unless you've got a financial advisor that's telling you, no, you need that mortgage interest, don't do that. Take the money instead and put it into something else. If you have balances that you've got higher interest on that are higher than what your current mortgage is, then I would always tell you and recommend pay those balances off first before you apply extra to the lower interest rate that you have on the mortgage. And Michelle says, I don't have any credit card debts or student loans. It is just whether I want my money in my bank or the mortgage bank sooner than they expected. So again, that is a personal decision, whether you want to pay. Obviously, the faster you pay it off, the less interest that you pay over time. So that is always great, to do. But it's just a matter of what your financial goals are and if you need the interest and they're, so far. So I hope I answered your question, Michelle. Thank you for asking. I love that. And I love it when you guys get involved and you get on the show and you guys get interactive and you ask questions. I will be here next week, Wednesday, 1 p.m. Pacific time. I don't have any surgeries scheduled. I do have one surgery tomorrow. I'm getting 3 removed, but that is on my back. So again, there's nothing covering my face where I look silly or I feel silly. I know you guys probably don't care if I have bandages on my face, but for me it's difficult, and I'm looking at myself in the camera. So tomorrow I do have 3 that are being removed from my back. So that's not a big deal at all. You guys would never see it. I'll be on next week. No big deal. Week after that, no big deal. Week after that, all of February, I'm going to be here every single Wednesday at 1 p.m. But in March, so I will be here the very first Wednesday of March, and let me double check my calendar really quick. So I will be here the very first Wednesday of March, but then you guys will not see me March 11th, 18th, or 25th, because I am having another procedure done where I will be an absolute entire complete face will be a disaster. So you guys will see me every single week of February, and you'll see me the first week of March, and then I will go silent again for probably 3 weeks, and then I will be back, and I'm hoping that is the last of it. I am hoping. So fingers crossed. And if there is anything else that I have to get done, I am just hoping that it is not to my poor face. So I will be back. I will be back next week. If you guys have questions, you know how to reach me, Debbie@mortgagemomradio.com. Feel free to send me an email. It is me, the real person that responds. Give me a call. Call my office. It's 844-935-3634. You want to text me? My office number to text is 661-349-8300. You can call that number. You can text that number. You can call the 844 number. You can text the 844 number. Whatever you guys prefer to do. Go to the website, schedule, book an appointment, book a phone appointment. Love to hear from you. Love to see you. Share the video. Give me a thumbs up so that I can get some more views and get some things rolling. And I can't wait to see you guys next week with more information. So we'll talk real soon. You guys have a good one. Bye-bye.
She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.
I'm Debbie Marcoux, and I am the Mortgage Mom. I'm licensed by the Department of Financial Protection and Innovation under the California Business Consumer Services and Housing Agency, NMLS ID 237926. Also licensed in Arizona 0941504, Florida LO 76508, Georgia 69178, Hawaii 237926, Idaho MLO 208-023-7926, Illinois 031.005-8339, Nevada 57237, North Carolina I-210940, Oregon, Tennessee 184373, Texas, Washington MLO 237926.